Could that be happening to consumer stocks as well? That's the question. Now remember, they've been in favor this year with almost all of the stocks posting double-digit gains, but that also triggered higher valuations. A two-part piece, which is the last piece on First Word today. First, Jayesh Khilnani standing by to put the numbers and the historical valuations into perspective. Jayesh, good morning.
Morning, Neeraj. Yesterday, when I was working on this piece, little did I know that the FMCG index will actually end up as the worst performing index amongst all of them. And in fact, what happened with that is that from the record high valuation that we have, it dipped slightly, but the larger picture still remains. So what you have on the screen is a 1 year forward PE chart for the Nifty FMCG index, which is represented by the white line. What you have in terms of the other colors is that the blue line is the average PE of the last 5 years, which stands close to just less than 30 times. And if we can have the one standard deviation plus one standard deviation, that stands just above 32, which is the yellow line, and the red line denotes the +2 standard deviations from where the average line is, which is close to 36 times. But where are we currently is more than 38 times if you have a look at the last piece, and we were almost inching up towards the 3 standard deviation mark, which was just close to the 40 level. But with yesterday's price decline, we have in fact seen a dip in the valuation as well. But what the other interesting bit that stands out, Neeraj, from here is that only once in the past, in 2017, the valuation has gone above the 1 standard deviation or the 2 standard deviation mark. So, this is something of an abnormal impact that we had seen as far as the valuation is concerned. Now, this of course reflects in terms of the individual stock valuation as well, if we can have a look at that. So these are all the 1 year forward estimate PEs that we have from the Bloomberg terminal. What is important to note over here is out of the 15 members that make up this index, 7 of them have valuation in excess of 50 times 1 year forward earnings. So, nearly half of them at more than 50 times. And the lowest one, which is in the top 10, that is Imami, that also quotes at about 41.4 times, which in itself is more than the index that we saw, which was at about 38 times. So, maybe a little too stretched, maybe a little too much on the higher side in terms of the individual stock valuation as well, Neeraj. So, some numbers to give you perspective of how the 1 year forward of about 38 times comes about.
Yeah, I think the more interesting bit was the first chart, excuse me, which shows how significantly above premium valuations are we trading at. The 2 times standard deviation has been a barrier. We are comfortably above that. Let's see if we find our way back here. But so what are the most expensive stocks and what are analysts saying about this FMCG basket?
So, Neeraj, out of the 15 stocks, there are 4 such stocks which are, trading more than 2 times their standard deviation as compared to their 10-year average. So, you have Dabur, which trades 3 times above the standard deviation. Godrej Consumer Products, 2.8 times above standard deviation. Britannia and HUL also 2.3 to 2.7. And remember that these are heavyweights. So, these actually moved the index. Yesterday, we saw that the Nifty went down about 100 points, largely contributed by ITC and HUL from the FMCG pack. And if you have a look at what the analysts are saying, just going by the target price, there's not much room for upside when it comes to these FMCG stocks. So some of them have in fact negative potential, which means that either the stocks have run up too fast for themselves, or the analysts will in time revise their target prices upwards. But even if you have a look at where the return potential is positive, have a look at the numbers. So not much to go by, just about 1 to 2% upside that the analysts are expecting on some of these key counters. So, overall, if you have a look at the target price, some of them are fairly priced, some of them may look overpriced as compared to, when we compare it to the target price that the analysts have on the street.